Hey guys, it's Nick, and in this video I want to talk about the weird things that's been going on in the market. Things like the Dow making new highs while the Nasdaq being in a 10% correction. Also, other strange things like the Dow being up 2-3% and the Nasdaq being down 1 or 2% on the day, and also the opposite. Nasdaq being way up and Dow being way down by more than like 2 percentage point difference. And there's a real interesting article in Barron's about how often that happens, and you'll be really surprised to see when that happened the most and how much it's happening now. And so what does that foretell about the market going forward? And I want to talk about how it ties into the whole idea that a lot of people have been talking about, that people are getting out of growth stocks and going into value stocks because of the reopening of the economy. So should you follow them along into these value stocks, or is it already too late and these things are already too far up for you to really make some money on them before they have a pullback? So let's get into it right now. So here on Market Watch, they say the Dow ends at a record high while Nasdaq remains in a correction, and that hasn't happened in 20 years. What else happened 20 years ago? Oh yeah, the popping of the internet bubble. And so here they say the rally in the Dow was powered by industrials like Boeing, Walgreens, Home Depot, and they've been benefiting from the so-called reopening trade as investors shift their focus from technology companies that did well during the pandemic to those that might perform better as the economy recovers further. Now here is the article that Barron's has talking about how the Nasdaq is acting strange and what that means for stocks. They say that on March 9th, the Nasdaq did something it hadn't done in 20 years. It outperformed the Dow by more than 3.5 percentage points. Okay, so why is that a big deal? Well, they did the mining of the data to show you, and it's pretty surprising, to tell you the truth. Now you might say, all right, well, the Nasdaq was up much bigger than the Dow, no big deal, that's bullish, right? Not all the time, because large divergences in the two indexes aren't healthy. So whether the Nasdaq is up a lot over the Dow or down a lot from the Dow, that is very indicative of something not right in the market. And so here they say on January 3rd, 2001, the Nasdaq had its biggest outperformance over the Dow, 11.4 percentage points. And so no other day since the Nasdaq was created in 1971 has that even come close. But that was not bullish, because that came during the middle of a bear market that was caused during the bursting of the dot-com bubble. So I've been noticing this lately, that the Dow has been up like 1.5 percentage points and the Nasdaq will be down like 1% or something on the close. And that struck me as very odd. You don't see that very often, and I've seen it a few times now. So I was a little curious, and I wanted to actually dig into the data to see how often that happens. But Barron's did it all for me right here, so saved me a bunch of time, and this is really interesting. In 1987, which was the first big, stock crash in the modern times, really, 20% crash, that outperformance and underperformance between the Nasdaq and the Dow by at least 2 percentage points happened 14 times in 1987. And then leading up to the internet bubble, 98, it happened 13 times, 99, 33 times, and in 2000, 106 times, 2001, 63, and 2002, 22. And then it really hasn't happened again. But even during the before the great financial crisis, it only happened 3 times. 2017, it happened 2 times, and now in 2020, it happened 10 times. And only in the 3 months or so that we're in 2021, it's already happened 31 times. So seeing it happen a few times and not really knowing the data behind it, you don't think too much of it. But looking at this chart and seeing when that happens, what happens to the stock market as a whole during and after that time, this is a perfect example right here. And so looks like we're getting up to that level. And here in the Zero Hedge article, they say February was the worst month for growth stocks since the bursting of the dot-com bubble. And I remember during the dot-com bubble in late 99 or something, everything on CNBC was all about how value or dividend stocks were dead. They're dinosaurs. You don't need to pay dividends because you just reinvest it in growth companies. Growth companies don't have dividends because they use that money to reinvest it and grow quicker, whereas dividend companies are slow and, useless and not worth investing in. Of course, that was kind of the top of the market right there. And now here they're talking about market rotation from growth to value. And this is the year-to-date cumulative ETF flows as a percentage of assets under management. And so you see bank loans, energy, financials, materials are having big rotations into them. Value as a whole, utilities, and growth is losing some money, and government securities, bonds, treasuries, and stuff like that is losing money. And in this other Zero Hedge article, they say $100 billion has rotated back to value investing and more could be coming. So blue is the growth ETF flows in millions, and gray is the value ETF flows. And you see in December, growth was beating value here, but growth started losing money and value started getting money. And that's been the case going on through January, February, March. So if you believe that this rotation is going to last from growth to value, how do you play it? Well, you can just buy the DIA ETF, which is Dow 30 stocks, or you can buy something like Vanguard VTV ETF, which is the value ETF. And you see it has a similar chart pattern to Dow. And so I'm usually weary when every financial article and news program is talking about the rotation from value to growth, because a lot of times when they keep talking about it, it's usually the end of the run. So I wouldn't recommend going all in with this rotation now. There's got to be probably some kind of pullback in the future. And this is a weekly chart. And still here, I mean, it's definitely bullish, but there's nothing to stop it from, having a pullback to 115 or something along those lines. This is a daily chart, and it's also, kind of toppy here, like it's got to have some kind of pullback soon. But, it could pull back to 125 here on a daily and bounce or something. And here's some facts on the VTV. I mean, it has a very low expense ratio, 0.04%. It has a 30-day SEC yield of about 2.44%. And so its performance since 2004, its inception is about 8%. The 10-year is like 11%. 5 years similar. And the 1 year is showing 2.23% here. That's on quarter end. If you view it on month end, the 1 year is up 21%. So why would you buy this instead of just buying the Dow ETF? Because this has about 10 times more stocks than the Dow ETF. It has 328 stocks, and all these categories: basic materials, consumer discretionary, consumer staples, energy, finance. And so financials have been going up a lot, and it's 20% financials. So this is a good portion of the reason why it's up so much, including the industrials as well. So these 10 stocks make up 21% of the VTV ETF. And of course, they're the biggest ones. And you'll notice that in most of these large cap ETFs, these 10 stocks are pretty much the top 10 in most of them anyway. So here's a bigger list of all the stocks in here: Exxon, Verizon, Merck, Walmart, Pepsi, Cisco, Citigroup, Honeywell, Gilead, Target, BlackRock, 3M, Raytheon, IBM. So here you see some stats. 2021 estimated sales growth 7.5%, earnings per share growth 22.6%. Wow. And price to earnings ratios 2021 estimated 17.3. So you see that's where the value comes in, because the S&P is more like 25, 26 PE right now. So these are more of the value stocks in this ETF compared to the S&P 500. So guys, that's a look at the divergences between the Dow and the Nasdaq and the significance of what that usually means when you look at what happened in history. So whether you think that this means that there's a big market crash coming in the tech stocks, or you're just worried about all this stimulus spending and the dollar going down and us getting inflation and that kind of thing, and you're interested in kind of rotating some of your money into value stocks, VTV is a very good and cheap and very efficient way to do it. Now, I wouldn't go jumping in with both feet into something like VTV because, like I said, when everybody on CNBC or Yahoo Finance or Barron's or whatever is talking about the rotation into growth, usually it's already, most of the move is already done. So take that with a grain of salt. Maybe look to buy some on any pullbacks. If you like this video, hit the thumbs up, and I'll see you in the next one. Thanks for watching, guys.